When you think about capital stacks, you're basically thinking about the mix of claims on an asset or the cash flow of an asset across the whole capital structure. So you have to see it somehow as a building, right? So you have the foundation of the capital stack is basically the equity part. So it's where the risk, most of the risk is taken. It's where the weight of the whole capital structure actually is on. And also, obviously, the returns are also, considering the fact that you take more risk, returns are also commensurated. The critical part of capital stacking, I think it's, in my view, is definitely understanding the cash flow of the asset or of the business that is under consideration, and model them in such a way that the capital stack is sustainable and also can attract the interest of this universe of potential players. As you start to have this, let's call it hybrid part that stays between the pure equity and the debt, and let's say senior secured or unsecured debt, it's very important to have a robust legal structure. Legal means, in a broad term, is the documentation that obviously describes who has priority on what. The commercial law is critical to define the priority if something bad happens. It definitely goes down to the sense of responsibility, to the accountability of a borrower and also of the partners that are working with the borrower. The sense of responsibility of each company, of professionals, is always to look through the cycle. So when you look through the cycle, you need to stress your model, so there is a lot of risk management activity that needs to be done across the modeling of an asset. Also, you need to structure the capital stack in such a way that, again, that it's resilient and robust through the cycle. Because when you have an issue, whether you default or whether you are in face inability or you have to face your creditors, you have to face, it's never a good thing to do. So I've seen the GCC moving from a situation that was largely binary, where you had equity and debt, to something that is a little bit more evoluted now. It's more complex, and this is driven by various, I would say, trends. One is the fact that many investors have evolved in terms of their ability to take different risk-return profile, and that obviously helps because on one side, normally debt is taken by banks and is dominated by banks, but there is this hybrid part in the middle that can actually be exploited by people who don't want to take full equity risk, but they're happy to be somehow subordinated to senior credit. The interest rate cycle has also been an important element in developing a little bit more appetite, because when when interest rates are low, people tend to look for, we like it or not, more potentially risk averse, so they start to look for better yield, for opportunities to somehow take advantage of, and they are prepared to exchange, a little bit more risk for better return. Where probably the GCC countries have room to help the market, to do something to promote the market even further, is more on the commercial law, where there is still a situation that it's often not 100% clear. There is not enough jurisprudence. So it's important that the country and the UAE and generally the region to have a little bit more articulated capital markets and different players, attract more players also that are not only banks but also maybe private credit fund, new players in the market that are disintermediating the banking system. It's very important to have a very solid and robust commercial law. If you don't have that one, obviously you have somehow a competitive disadvantage. Aldar is a company that has fully embraced, not as because it's a sort of fashionable theme to talk about, but we have been really putting our money where our mouth is. More than 50% of Aldar financing today is either in the form of sustainable link loan or green sukuk that we have been issuing, especially in the last 2 years, and very successfully. The role there, that banks and corporates are playing, it's very important, but it happens primarily at the debt side. So from a capital stack perspective, I think everything that it's in between, so what it's called somehow hybrid, whether it's mezzanine or sort of hybrid capital, normally investors are maybe less sensitive. They look more at, so they've not probably developed from an incentive perspective the sensitivity around these topics, partly because most of the money that goes into, or at least a good chunk of the money that goes into hybrid or mezzanine or in the middle of the capital stack is very often proprietary money. And so if you take, for example, a senior loan or a senior bond or a sukuk, normally the investor is someone manages third-party money, right? So that has somehow mandates from investors that are demanding, and they say, I want to invest into ESG or a green financing compliant structure. And that's obviously, I think it will develop over time because the topic is very important, and it's for the benefit of generally of the world and of ourselves as human beings. But it's probably taking a little bit of time to go all the way from the debt side down to the equity. Even anecdotally, when we talk to equity investors, for example, the sensitivity to the topic is there, but is not as broad-based as on the debt side. The level of interest that there is from the outside world to participate generally in the GCC story is such that it would constitute, if you also couple it with the strong, I would say, leadership view of making these places, making the UAE, but also generally the region a destination of choice for businesses, also that part has to step up and become state-of-the-art. The banking system is subject to very heavy regulation from a capital perspective, and implementation of Basel III, for example, tends to push the banks towards the less risky part of the capital stack. So normally banks are happy to lend into the senior part of the capital stack, so whether it's secured debt or unsecured debt, and with possibly with the rating, so their capital requirements are minimized. And that obviously creates a lot of space in the middle, so between the equity and the debt part for other players who want to participate. If you are a pure real estate investor who's prepared to lose an asset and simply is after basically minimizing his equity exposure and maximizing the return on that equity, then you want to have a capital stack that is as articulated as possible. So you try to slice the cash flows generated by an asset or by a portfolio of assets in such a way that allows you basically to have different layers in the capital structure, and then what is left normally is the remuneration for your equity. So you try to minimize your equity exposure, and if things go well, normally you will get basically an FT return, but is also commensurated to the risk. So what is important there, it's definitively the ability to model the asset or the portfolio of asset cash flows, and make sure that you are always in a position to satisfy the various claims on the asset. So the cash flow waterfall goes top down. The GCC is very similar to the European market. So there is both at the corporate level, at an asset level, there is always a very high reliance on the banking system. Today, banks are taking much more, I would say, considerate risk compared to what they were doing in the past. Normally they sit at the very top, but they have the, I would say, the responsibility and the onus of working with the borrower and making sure that what is brought to the market generally, both on a syndication or if you bring in investors in this hybrid space, the model has to be, the asset has to sustain that. So I think it's not only a matter of being opportunistic, it's a matter of being strategic. It's very important that banks make sure also that when they work with borrowers, that documentation, for example, has to be solid, has to be unambiguous, it has to be clear, and this avoid any gray area, and also be aware of what the commercial law says. Today, if you take the GCC area and you would push for, let's say, aggressive capital stacking, you also need to be aware that if something bad happens, your claims might be not as clear from a bankruptcy procedure treatment as you would like them to be. Generally, there are two extremes when it comes to financing and capital stacking in real estate. I think it depends a lot on the funding model that a company follows. If you are an alternative asset manager, you would normally follow a no-recourse model. So basically you would be putting your equity, you would try to load as much debt in the form of senior debt or in the form of mezzanine debt, but you will also have a different approach to the managing the asset, and you would be prepared to lose the asset if something goes wrong. So Aldar does not do basically funding at an asset or a project level. We normally do funding at a corporate level. So we raise money only in two places. One is a private REIT, a sort of private REIT that we have, and it's basically a ring-fence company with its own governance, its own financial policies, board, and so forth. And that's where it's where we do some part of the funding. And the rest is done at the corporate level that acts as an in-house bank. So basically funds each business according to the needs. And the important thing is to avoid commingling. What we are trying to do to create technically what is called structural subordination for senior lenders. So we try to keep a model that is as pure as possible. Doesn't mean that it's superior to the other one. It simply fits with different needs that Aldar has compared to an alternative asset manager or a securitization structure, for example. At the beginning of 2025, we issued a very innovative transaction in the region that it's a dated hybrid that has never been issued here. And we have done a lot of work with the bank and with the rating agencies also to prepare an instrument that was exactly in the middle of the capital stack so it's junior to the senior debt. The hybrid holder will get remunerated after the senior bondholders senior debt holders have been remunerated. It's an instrument that gives us flexibility in the capital structure. It's an instrument that we issued 1 billion, we got orders for, it has been 3.8 times oversubscribed, and it had an order book at a certain point of close to 5 billion. And it has seen a very broad participation. This is a testament to trying to be innovative pays out. If you have a clear instrument in the middle of the capital stack for a company like us that conveys and provides a great risk-return profile for investors, we need to be prepared for an event. And that's the way we look from let's say, a risk management approach to these kind of topics.